What is land tax? Who should pay it? Does it apply to my home? And can I reduce this major property cost, which just seems to be eating away at my rental income disproportionately? These are the sort of questions that are often asked by serious property investors who already have or are in the process of building a significant property portfolio. So to answer your common land tax questions, I'm going to have a chat with Australia's leading tax strategist, Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Hi, Michael.
Now, I'm sure you get asked these questions a lot, and these are the questions that the property strategists at Metropole are asked and that are left on our website. So let's work through a couple of them. The first question, Ken, what is land tax? Because to me, it just seems like a wealth tax.
And many of our clients and non-clients think exactly the same. So land tax is exactly that. It's a tax that is applied on an annual basis to the land value of your investment property. So it's not the total value of the property, it's only the land component. And each state has got a different level that they apply, but it's charged annually. And as your land values grow, as we all hope they do, your land tax assessment bill will grow.
Now, what happens is, of course, it actually doesn't grow proportionately. It seems to add more the higher your levels get, a bit like tax rates, Ken.
Different states have got different calculation methods. So as an example, New South Wales has got a flat rate that it is applied. Different states have got incremental rates that they apply, similar to the marginal tax rates.
Now, it's interesting because like other taxes, Ken, this is a self-assessment tax. So you've actually got to submit a land tax registration form or variation form when you buy a property, or depending upon which entity owns the property, Ken.
Correct. So the actual land value is determined by the government through the Valuer General. And as a quick look to see what approximate value there is, if you go to your rates notice and have a look at the unimproved capital value, that'll give you an indication of what the government is using. But you need to register. So you register for land tax purposes, and if there's a change in your circumstances, you've got to do a variation.
Now, the land you own and occupy as your home, as your principal place of residence, that's exempt from land tax. And each state has also got a threshold. Is that correct, Ken? Where above a certain rate you pay land tax?
Correct. So let's start off with the home. So most states only give you that free land tax benefit if the home is in your personal name. But more importantly, you're using and occupying that property as your home, then you would be land tax exempt. Now, different states have got different methods of calculation. So some apply a flat rate. Others have got a threshold where, depending on what that threshold is, the land tax is zero below that rate. And then there's a land tax that applies post that. And one of the things we've seen as a way for the government, state governments to increase the land tax is if there's potentially a foreign owner, then there's an additional surcharge levy applied to land tax, which effectively basically doubles what you would have otherwise paid if you're a resident owner.
And also in some states, trusts and companies are charged a different, more expensive land tax rate, Ken.
So they're either charged a different rate, a higher rate, or the threshold where the land tax begins is lower. As well as that, there is a surcharge for land tax in most states once the dollar value gets to a certain level. So call it a higher level, then there is, can I say, more punitive land tax rates, because the government assumes if you own land at such a high level, you can afford to pay more.
And that's why I call it a wealth tax, Ken. But the questions that tend to be left on the Property Update website are about varying your home a little bit. So we know that your home under normal circumstances isn't subject to land tax, but what if a couple owns it? What if I own it in my name and my wife's name, my partner's name?
That's very important, particularly if it's an investment property. But coming back to your question, if it's the family home, then as long as the occupiers are using it as the family home, then you get the exemption. So if you've got a couple and the ownership is just in one name, as long as the couple are living there, they both don't have to be on title. But I had the circumstance very recently where a property was owned by a brother and his brother, and half the property was being used as an investment. It was a dual occupancy site, and the other half was being used as the brother's owner occupied. So therefore that site was only entitled to half the land tax exemption, representing that half that the brother was living in there as their home.
Ken, what happens to land tax if I move out of my home, if I choose to use it for an investment for a while?
So it now becomes an investment property when you move out, and you've got to go and advise the individual state government that that property is, that you're now no longer using it as your home, but as an investment. And you would now start getting a land tax assessment. Depending on the value of the land and what other land you own, you could be now having to pay land tax.
Now, some people are going to confuse this with that 6-year exemption absence rules for capital gains tax. These are very different things, aren't they?
Very different rules. So, and one's federal government, so it applies equally across all the states in Australia. That's the capital gains tax, where if you move out of the home, you get a 6-year absentee benefit. But land tax exemption only applies if you live and occupy that property as your home. So when you move out, it's now an investment property. So the state government would now look at applying land tax.
Ken, are there any traps, any tricks that as a homeowner or property investor we should watch out for with regard to land tax?
I think there's two. The simpler one is if you're using a trust to own that investment property, what is on the title is the trustee. So if it's a company has a different land tax calculation and methodology than a trust would. So the computer system for the state sees a company name and applies the land tax rate for a company. So if you didn't register and identify there was a trust, you're actually underpaying in most states your land tax. And if you ever got an audit, you would then have to pay the additional amount. So it's very important when you're buying a property off somebody to actually get a land tax clearance certificate so that you as new owner aren't liable for the land tax of the previous owner. Because land tax for most states comes out, the assessment in February, based on the prior year. So if you've bought in that intervening time, you are now the owner, you would have to pay the land tax for the previous person. So make sure you get a land tax clearance certificate when you're buying an investment property. And secondly, make sure that you're properly registered so the correct rate is being applied for your specific circumstances.
Great tips. Now, a lot of people buy investment properties and trusts. So up to now, we've talked a bit about homes, but do all trusts have a higher level of land tax applied to them?
Look, I think you'd have to say as a umbrella answer, the answer would be yes. Particularly in New South Wales, it's much more punitive. Victoria is the same. Queensland has different rates for a trust versus an individual. Some of the other states don't make a distinction. But you've really got to ask, what are you trying to achieve by using a trust? So a lot of our clients use trusts for very specific reasons, such as flexibility, asset protection, estate planning, and they still use the trust for those benefits, notwithstanding maybe there's an additional land tax to pay. So be very careful on why you're using a particular structure and balance the pros and cons.
That makes a lot of sense. Now, clearly the advice we're giving is very general advice. So I think we've got to give a disclaimer, Ken, that land tax is a state-based tax and this is really broad information. And so it can't really do justice to your own circumstances. But if you've got any questions about this, in my mind, Ken Race is Australia's leading tax strategist. So why not have a chat with Ken or his team at Metropole Wealth Advisory? And the website's on the screen at the moment. So if you go to Metropole and have a chat with Ken to understand what your tax obligations are. And it's best, Ken, to do that before you buy a property to make sure you set it up the right way.
Correct. So make sure that you've identified the correct structure to buy in, which means you have to have that completed prior to purchase. That will also, in some limited circumstances, maybe impact on your borrowing capacity. So you want to have that discussion with your finance strategist as well. And then make sure that you register correctly so that you're paying the right level of land tax at the appropriate time.
And you can't leave that to your solicitor or conveyancer, because the name on the title is not actually the owner if it's actually in a trust. That was a really great point you made out, because I know a number of people who got caught with that and ended up having to pay quite some penalty rates. Thank you very much for your time, Ken.
Thank you, Michael.